There's a number on your retirement statement you've probably never looked at twice. It's usually written as a percentage, 1 point something. It looks small. It's supposed to look small, but run that number across 35 years of your career and it can quietly take over $200,000 of growth that should have belonged to you. Not because anyone stole it, because you never questioned it. By the end of this video, you'll know exactly how to find that number on your own accounts and what it's really costing you. You were probably taught to focus on returns, pick a good fund, contribute consistently, let it grow. That part of the advice is right, but there's a second number sitting quietly next to your return, and almost nobody teaches you to look at it. It's called an expense ratio, or a management fee, or an advisory fee depending on the account. It's usually somewhere between 0.5% and 2% a year. And here's the part that matters. That number isn't designed to alarm you. A fee that said, "We're taking 20% of your lifetime growth," would get read immediately. A fee that says 1% gets skipped. That's not an accident of language. It's just how percentages work on the human brain. A small number, repeated quietly every year for 30 years without anyone ever adding it up for you. So let's add it up. Let's use a simple, realistic example. Say you invest $500 a month starting in your late 20s for a 35-year career. Say your investments earn an average of 8% a year before any fees. That's a reasonable long-term assumption for a diversified portfolio. With no fee at all, that $500 a month grows to just over $1,030,000 by the end of your career. Now add a 1% annual fee, which knocks your net return down to 7%. Same contribution, same 35 years, same discipline. Your ending balance drops to around $829,000. That's a gap of roughly $204,000. Not from a market crash, not from bad luck. From 1 point of a percentage taken quietly every single year. And if that fee is 2% instead of 1%, which is common in some actively managed or advisor-sold accounts, your ending balance drops again to around $669,000. That's over $360,000 lower than the zero-fee version for the exact same effort, the exact same contributions, the exact same 35 years of showing up. And here's the part most people never see because nobody ever runs the math backward for them. Run it backward instead of forward and ask a different question. Of the money you actually ended up with, how much of your potential ending balance did that 1% fee quietly remove? The answer is close to 20%. 1/5 of your entire ending balance, gone to a number that was never designed to look like 20% of anything. It was designed to look like 1%. That gap between how small a fee feels and how large its actual bite is, that's the whole mechanism. It's not a scam. It's not even hidden technically. It's just math that almost nobody is ever shown in these terms. You might be thinking, okay, but is my fee actually that high? That's a fair question. And it's worth pausing on because the range is wider than most people expect. Broad market index funds, the kind that just track something like the total stock market, tend to charge somewhere between 0.03% and 0.20% a year. That's close enough to free that it barely shows up in this math at all. Actively managed mutual funds, the kind that try to beat the market by picking stocks, average closer to 0.5% to 1% a year in the US, and some run well above that. Accounts managed by a human advisor charging a percentage of your assets often land between 1% and 2% a year, on top of whatever the underlying fund already charges. So the gap between the cheapest option and the most expensive one isn't small. It's the difference between the $1 million version of your future and the $669,000 version for identical contributions and identical time in the market. Here's what's actually worth doing with this. You don't need to become an expert in fund management. You need about 10 minutes. Log into any retirement or brokerage account you have, a 401k, an IRA, a taxable brokerage account, and search for the term expense ratio for each fund you're holding. Most platforms show it right on the fund's summary page. Write the number down. If you're paying an advisor a percentage fee, ask them directly what that percentage is and what it includes. You're allowed to ask that question. It's your money. Then compare what you find to the ranges you just heard. If your number is meaningfully above 1%, it doesn't automatically mean something is wrong. Some strategies and some level of guidance are worth paying for, but now you're choosing that cost with your eyes open instead of paying it because nobody ever pointed at the number. Here's the number this whole video has been building to. Over a 35-year career, the difference between a 0% fee and a 1% fee isn't 1% of your money. It's roughly 20% of your ending balance. $204,000 from a single percentage point, compounding in reverse for 3.5 decades. That's the real trick of a small, boring fee. It was never designed to feel like a fifth of your future. It was designed to feel like nothing at all. You don't have to overhaul your entire financial life to fix this. You just have to know your number. That's the whole lesson. A fee you can see is a fee you can question, and a fee you question is one you can actually do something about. If this was useful, subscribing helps more than you'd think. It's how this channel keeps making videos like this, instead of ones that just tell you what you want to hear. A like helps it reach someone else who's never looked at their own fee line either. And if you've got a minute, I'd genuinely like to know, did you check your number yet? And what did you find? Drop it in the comments. You might help someone else finally go look at theirs. You can also find more of this over on Instagram and TikTok. Links are in the description. And the channel also has a shop on Gumroad with a few tools that might be useful. Links in the description too. Either way, go check your number. It's been sitting there this whole time.